At first glance, investing seems like it should be easy. Just buy shares in good companies, sit back, and profit. As easy as that sounds, that's not how investing works. And the good company is a good investment fallacy is something that every investor needs to understand. Popular companies, the companies that you have heard of, with great stories behind them and great prospects ahead of them, will tend to have higher prices because more investors want to own them. Higher prices lead to lower expected returns. This phenomenon has been studied extensively and the conclusions are clear. Less popular stocks, the ones that you haven't heard of and probably wouldn't want to own if someone told you about them, deliver better returns than their more glamorous counterparts. I'm Ben Felix, portfolio manager at PWL Capital, and today I'm going to tell you why good companies are not necessarily good investments. There is, of course, no formal definition of a good company. Peter Lynch popularized the idea of buying what you know. Think about the companies that everybody has heard of. These companies are typically huge, their products and services are used or admired by most people, and their businesses are robust profit-generating machines. They are objectively good companies, and on their rise to becoming household names, they have often delivered exceptional returns to their investors. There are a few different ways to measure which companies are perceived as good businesses by investors. We can look at brand value measured by Interbrand's annual Best Global Brands report, competitive advantage measured by Morningstar's economic moat ratings, company reputation measured by Nielsen's Harris Poll Reputation Quotient, Fortune magazine's annual list of America's most admired companies, and from a market pricing perspective, companies with high past returns and high price multiples. Given some measure of a company that is perceived as good, the question that we need to answer is whether these companies are good investments going forward. In the CFA Research Foundation publication titled Popularity: A Bridge Between Classical and Behavioral Finance, the authors develop an asset pricing model that includes measures of company popularity. To measure the effect of popularity on investment returns, they sort stocks based on brand value measured by Interbrand's annual Best Global Brands report, competitive advantage measured by Morningstar's economic moat ratings, which assesses things like network effects, intangible assets, cost advantage, switching costs, and efficient scale, and company reputation measured by Nielsen's Harris Poll Reputation Quotient. For the study period spanning the year 2000 to 2017, they find a monotonic negative relationship in their sample between brand value and stock returns, where the highest brand value stocks had much lower returns and lower Sharpe ratios. Over this period, a dollar invested in the least popular stocks measured by brand value dramatically outperformed the most popular stocks. For competitive advantage, they find from July 2002 to August 2017 that companies in their sample with no competitive moat beat the companies with the widest moats by a wide margin. Finally, companies with the best reputations from 2000 to 2017 trailed companies with the worst reputations by over 5% per year, while also being more volatile. Statman and Angener had similar findings in their 2010 paper, Stocks of Admired Companies and Spurned Ones. They find from April 1983 through December 2007 that more admired companies, measured by Fortune magazine's annual list of America's most admired companies, had lower returns on average than the stocks of spurned companies. They find that increases in admiration are followed by, on average, lower returns. The 2010 paper, Glamour Brands and Glamour Stocks by Billet, Jang, and Rigo, finds using a unique dataset based on customer opinions about their perceptions of a company's brands that companies associated with more prestigious brands tend to have higher prices, particularly when investor sentiment is high. The effect decreases with institutional rather than retail ownership of the company. They find that companies with high prestige tend to have low future returns. In his 2011 paper, Investor Sentiment, Stock Characteristics, and Returns, Mayer Statman explains and finds evidence in support of the sentiment hypothesis, which states that sentiment misleads investors into believing that the stocks of companies with relatively positive sentiment will yield higher returns than stocks of companies with relatively negative sentiment, and that sentiment is elicited by the names of companies rather than by their characteristics. The sentiment hypothesis claims that the names of some companies elicit positive sentiment and that the halo of positive sentiment misleads investors into the belief that these stocks will provide high future returns with low risk. This combination is, of course, unrealistic and leads to low realized returns for the investors who pay high prices for the stock. Another important hypothesis comes from the 1994 paper Contrarian Investment, Extrapolation and Risk by Lukanishok, Schlafer, and Vishny. They explain that glamour stocks, stocks that have performed well in the past and are expected by the market to perform well in the future, may underperform value stocks because investors make judgment errors and extrapolate past growth rates too far into the future, or they may simply make the error that the well-run firms are good investments regardless of the price and overpay to invest in the business. Glamour companies tend to be companies that have done well in the past and are unlikely to become financially distressed in the near future, which makes them attractive to institutions who want to appear prudent. Of course, this prudence is only a story that investment managers tell. In reality, Lukanishok, Schlafer, and Vishny report that glamour stocks earn lower returns and are not fundamentally less risky than value stocks. Hirsch Shefrin explains in the 2019 paper Valuation Bias and Limits to Nudges that even analysts are prone to extrapolating growth too far into the future. He shows that all sell-side analysts covering Facebook, Amazon, Netflix, and Google exhibit a growth opportunities bias. Basically, they assume that the firm will be able to maintain its exceptional growth forever, which is not what has happened historically with successful companies. Stocks that tend to do really badly when the market does badly are companies that many people would think of as bad businesses. Just think about how well good businesses like Amazon and the other tech giants did when markets crashed in March 2020. Campbell and Sadiq find in their June 2000 paper Conditional Skewness in Asset Pricing Tests that negative co-skewness, bad returns in bad times, is priced, commanding a risk premium of 3.6% per year on average in their sample. In Popularity, a bridge between classical and behavioral finance, the authors extend the co-skewness sample for the subsequent 20 years and find that companies with the most positive skewness, the ones that decrease tail risk in a portfolio, trail those with the most negative skewness, the ones that increase tail risk, by nearly 4% per year. Finally, lottery stocks, stocks with highly positive unconditional skewness, meaning a high probability of poor returns with a low probability of extremely positive returns, which we know empirically are popular with retail investors, have historically performed very poorly. One of the best examples of lottery stocks is recent IPOs. In a 2011 paper titled IPOs as Lotteries, Skewness Preference and First Day Returns, the authors explain that IPOs with high expected skewness experience significantly greater first day pops. Good companies tend to have high prices because they're highly profitable and have low costs of capital. Value stocks tend to be less profitable and have higher costs of capital, which is why they have lower prices. In their 2006 paper, The Anatomy of Value and Growth Stock Returns, Eugene Fama and Ken French show empirically that growth stocks, the good companies as determined by market prices, tend to eventually see their valuations decrease as their profitability and earnings growth decline, while their cost of capital increases, pushing down their valuations. This so-called convergence in valuations is largely what explains the underperformance of glamorous stocks relative to their shunned peers in the long run. It is true that some companies can defy the odds and deliver high unexpected returns despite having low expected returns. We saw this with tech in the US market for the last decade or so. I don't think it makes sense to base decisions on the unexpected return. Expected returns in financial economics are not like gravity in physics. They're not a law, but they are a pretty good model for the world. The higher asset prices get, the lower expected returns get, all else equal. Low expected returns can manifest as slow pain, where returns are low for an extended period of time. They can manifest as fast pain with dramatic drops over short periods of time. ARC comes to mind. Or, as they often do, they can manifest as some combination of slow and fast pain. Either way, expected returns tend to be pretty good predictors of realized returns in the long run, even if there is a lot of noise in the short run. Good businesses are not necessarily good investments. The perceptions held by retail investors on which companies are good, measured multiple ways, are negatively related to stock returns. Based on the evidence, good companies are bad investments from the perspective of investment returns. What matters for expected returns is the price that you pay for future cash flows. All else equal, a lower price indicates a higher expected return. Higher expected returns also indicate more risk. Companies with low prices are not typically glamorous, popular, or loved by consumers, and they tend to do poorly in bad times. Counterintuitively, those unloved companies tend to be good investments for the investors willing and able to bear the risk of owning them. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who you think could benefit from the information. We also discussed this topic in episode 174 of the Rational Reminder podcast.